Imagine checking your account to find equity has dropped 15% overnight, instantly erasing 6 months of steady gains. For much of the last decade, this was an outlier. Traders treated the carry trade as a passive income stream that required little oversight. The strategy relied on borrowing currencies with zero interest rates, like the yen, and using those funds to purchase higher-yielding assets elsewhere. This approach relied on the availability of cheap capital, but central banks moved away from negative interest rates, meaning borrowing now incurs a real cost. The new divergence has become the mandatory framework for 2026, shifting the primary focus from passive holding toward active management. Navigating this environment requires a specific understanding of broker math and macro shifts, as chasing raw yield now carries risks regarding liquidity and borrowing costs. Many traders mistakenly focus on advertised central bank rates. However, the profit you actually keep is defined by your net carry. Calculate net carry by subtracting your broker's markup from the central bank's rate differential. For example, if the Fed is at 5.25% and the BOJ is at 1%, the gross difference is 4.25%. With a 0.75% broker markup, your actual yield drops to 3.5%. Settlement timing also matters. Most Forex pairs operate on a T+2 basis, meaning positions held past 5 p.m. Eastern on a Wednesday typically earn or pay a triple swap to account for the weekend. In a high-interest environment, these rollover mechanics in broker swap points can represent a significant portion of your total return or loss. The new divergence strategy relies on matching economies that are moving in opposite monetary directions. This starts with identifying yield leaders, countries like Australia that maintain higher rates for longer to combat structural inflation. These are paired against funding candidates, where central banks are forced into early rate cuts to manage high debt or slowing economic growth. This pairing creates a risk known as funding appreciation. If the currency you borrowed strengthens unexpectedly, the cost of paying back that loan can exceed the interest you earned. In 2026, a central bank's trajectory, whether they are likely to hike or cut next, is more important for selection than the current interest rate alone. Market volatility is a primary threat to these positions, following the adage that carry trades go up the stairs and down the elevator. This happens because of a crowded trade. When a large number of traders are long the same pair, a sudden trend reversal leaves very few buyers to absorb the selling pressure. Monitoring the VIX provides a specific warning. A VIX reading sustained above 22 often signals a regime shift, where high volatility begins to trigger margin calls and liquidations. These black swan unwinds cause liquidity to vanish, leading to price gaps that can take months or years to recover from. The carry trade is inherently fragile because its profitability is sustained by low market volatility. Standard, tight stop losses are often ineffective against the large price gaps and low liquidity seen in 2026. Traders use the average true range, or ATR, for dynamic stops, surviving normal daily market noise without premature liquidation. This creates the carry-to-risk ratio. Divide your daily swap credit by your total potential stop-out loss to determine if a trade is mathematically worth the risk. Beyond price, capital preservation in this environment requires the use of time-based exits. This involves completely exiting or heavily hedging a trading position 24 hours before any major central bank announcement. Avoiding high-stress news events is a more consistent way to protect accumulated interest than gambling on economic data outcomes. Success in 2026 involves the carry trade as a way to collect a credit while waiting for a macro trend to play out. Discard the passive mindset of previous decades and actively audit your current portfolio's exposure. You can use the FXNX real-time swap calculator to ensure your net carry justifies the drawdown risk you are taking. Join the traders on NX1 for institutional-grade technology and 0.0 pip spreads.